Hello and welcome to Rebank. I'm your host, Will Beeson. Man, is it good to be back. I've had the pleasure of connecting with so many of you offline over the past year or so as I build a new project in Fintech. Today, I'm thrilled to be sitting down again with an amazing guest, Amias Gerety. Amias is a partner at QED, one of America's leading Fintech investors. He has a specific focus on infrastructure, insurtech, and payments. Prior to QED, Amias served as the president's nominee and acting assistant secretary for financial institutions at the U.S. Department of the Treasury. In that role, he was the lead advisor to the secretary on policies affecting financial institutions, fighting to restore order during the global financial crisis, and impacting policy in the years that followed. In this conversation, Amias and I discuss a few counterintuitive views on venture capital, thematic versus opportunistic early-stage investing, opportunities in payments, and more. Thank you very much for joining us today. Please welcome Amias Gerety. Amias Gerety, welcome to Rebank.
Thanks for having me. Glad to be here.
Great to connect with you. I'm a huge admirer of your guys' work at QED, and I look forward to diving into that along with some of the ways you think about venture investing in today's conversation.
Excellent.
To kick off, tell me about impossibility theorems, what that means to you, and how you use it as a lens in thinking about investing.
So I like to remind ourselves that venture is actually a very unusual place to invest. And most companies have a really low probability of success. And so often, rather than starting from the perspective of, I know X, Y, or Z is going to happen, I like to start from the perspective of like, here's all the reasons, very simple statements that everyone would pretty much agree with why investing in this category is a bad idea. So I'll use actually one of my favorite categories, which is insurtech. So let's talk about insurtech from the perspective of an impossibility theorem. QED is a very large fund. We're very global. We're about to launch into Fund 8, deploying our first checks right around now. Fund 8 is a $650 million early stage fund and a $275 million late stage fund. So we really need to invest in very large outcomes. So let's apply that to insurtech. Well, one thing I know, and I love these businesses, I think they're super interesting, but I would call them a niche MGA, so a managing general agent, where you partner with an insurance company to take the risk, and you really have some underwriting or theory about how you're going to acquire customers in a given space, right? So, but it's a narrow space. Well, I definitely shouldn't invest in those as a big fund because I've already told you it's a narrow space. It's a small TAM. And then you say, well, certainly that means I should invest in what's left. Well, personal lines. Home, auto, right? These spaces. And I'm on the board at Kin, which is a direct-to-consumer home insurance. So certainly personal lines make sense. Well, boy, I mean, personal lines, very commoditized, especially for auto. And I already told you I'm already invested in home, right? Very strong competitors with huge brands. So boy, I don't want to do a startup auto lines company. That just doesn't make sense. And then you say, okay, well, what's left? Well, certainly as a venture investor, we love SaaS, right? We love software companies with high margins. But I'll tell you, and you know this, Will, the only people who are worse buyers of software than bank executives are insurance executives. So there, in 3 quick statements, I've told you there's actually no investments we should make in insurtech. And I also told you that I love the idea of investing in insurtech. So that's my idea of an impossibility theorem, is start from some very simple statements that make the answer no. And that actually sets your mind right to really hold a high bar and to look for ideas, teams that are truly special because they're going to flip conventional wisdom.
Got it. So you're basically eliminating that natural optimism or enthusiasm that you probably have as an investor, that entrepreneurs surely have as founders, and you're forcing the concept, any idea that you're going to back, to basically be so either counterintuitive or interesting that it surmounts those blockers that you've set up to begin with.
That's exactly right. There's a saying which I adopted from Norm Macdonald, the comedian, who, he's got complicated dynamics But he had this idea of a perfect joke. And a perfect joke is a joke where the setup and the punchline are the same words, just with different emphasis. And I think we have a version of that in venture, which is, well, our job is not to invest. Our job when we get up every day is not to invest, right? What you do every day that you do your job as a venture capital is you don't invest in things. You have to start from the perspective that it's an awesome job to be talking with entrepreneurs and hearing their optimism and their passion, but we're going to say no to most ideas. And so we want to start from a real true understanding of why most ideas will not succeed before we allow ourselves to get excited about why this idea or this team might succeed.
Maybe we can use a specific example of how you deploy that thinking in the real world. So, I mean, you talked about insurtech. You talked about the reasons why you might not want to invest in the range of insurtech verticals yet you have. Can you talk about an investment that you've made and how it functioned within the context of that lens?
Yeah, for sure. And I'll use Kin as an example. I mean, Kin is a very large, successful company. Recent valuations, make them a unicorn. So that's exciting, and it's been great to be on the board there. We invested in Kin after a period where we actually hadn't done any insurtech deals for over 3 years. And the opposite of the impossibility theorem is, we were having a conversation internally, and I sort of said, well, wait, the answer shouldn't be no. The answer's got to at least be maybe. Right? If the question is insurtech, it can't be no. It's too big a space. And what we saw in Kin was a company that was really doing things different. And at the surface, it looked like a lot of other direct-to-consumer insurtechs. But underneath, the focus on underwriting, the focus on unit economics, and the focus on controlling their own capacity. So Kin uses what's called a reciprocal model, where the carrier is a nonprofit. And then Kin Inc. is called an attorney in fact, which means they sort of manage the risk on behalf of this nonprofit carrier. So it's actually a very common structure for a lot of large insurance companies, but it was an unusual structure for startups because it's quite difficult to get there. So we saw what looked like one more direct-to-consumer insurtech, but when we dug under the surface, we saw a company that at some level to us, and the background of QED is DNA from Capital One, it looked like Capital One for insurance. Because what Kin does best of all is it focuses on areas where the geography is affected by catastrophes. It's affected by hurricanes and severe storms. And those are dislocated markets, but they're dislocated markets where if you get the data right, you can get the pricing right. If you get the pricing right, you can serve your customers in a much better way. And by being direct to consumer, they get the benefits of being able to apply that data and being able to have that direct relationship so they can work with consumers in the midst of a storm, texting them, calling them, using aerial photography, all these things built up to a very different business model, even though on the surface, it looked like just another direct to consumer tech company that was trying to market in a more digital way.
So there's clearly a user experience element there when it comes to actually serving customers, but it sounds like they're targeting a space which is pretty well at this point adjacent to a lot of incumbent insurers, right? I imagine those areas, geographies where they're focused are areas where traditional insurers are less and less interested in playing, right?
That's exactly right. And you see this in the news all the time. There's really a constant fight. Whether it's California wildfire risk, where there was very public, large insurers pulling out, or Florida, where the number one carrier in Florida today is called Citizens. It is a state-owned carrier, and that's not what the state wants, and it's not what the market should want to have all that risk sitting on the state's balance sheet. So this is an example where in order to provide home insurance in a geography like this, you have to redo your underwriting models. You have to take it very seriously that two houses right next to each other on the same block might actually have very different risk. So that actually requires a level of technological sophistication and data science. So like our head actuary also is a data scientist. and there's a data science team on top of that. So just the level of depth and rigor that the Kin team was constructed to bring to the market really impressed us, because everything comes down to underwriting first. And then if you do that right, then you get the benefits of you can treat your customers better. You can earn their loyalty, earn their trust. If you can't get the pricing right, you can't be a good partner for home insurance.
I think that point about building a fintech business immediately adjacent to the space where incumbents operate is a crucial one. I think we learned as an industry a lot of lessons over the last fintech cycle about the opportunities to operate in the green space rather than take on incumbents head on.
Yeah,
as tempting as that may have seemed some number of years ago, there are lots of examples of how that didn't work. And maybe we can unpack that a little bit throughout the conversation. Picking up from there, one of the things I've heard you say is that VCs confuse hunting with gathering. I wonder if you could talk a little bit about that.
Yeah, so look, we in QED, and I think other people talk the same way, we talk about, hey, you got to be out there hunting for great deals. And I think that's a great thing to say. It's certainly true, because even though many people think, oh, it must be easy to be a VC, you just sit there and the entrepreneurs come to us, you've got the money, they want it. I often remind people who are not in this industry that any great deal is a competitive deal. Any great deal is a competitive deal. And that means being a VC is hard. You've got to go out and find those great deals. You've got to charm them, win them, convince them to take your money, because ultimately that's what we do. We sell the most commoditized thing in the world, which is dollars. And they spend just the same way if they come from you or they come from me. So it's certainly true that we've got to be out there and be hunting. But I find that in our day jobs, what hunting often looks like is the kind of thing that you and I do when we're not recording a podcast, which is, hey, what have you heard? What are you interested in? You got any good companies? What are you thinking about? It's this actually quite passive activity of networking. And the thing I worry about, both for myself and at QED in general, is that we think of this quasi-passive activity of talking to the people that you like, talking to the people that you respect, hearing what they're thinking about. That's actually a lot of work for relatively little reward compared to identifying a space, identifying a why now for that space, identifying 3, 4, 5, 10 companies at different stages that are in that space, and then really working to make sure you know the ins and outs of those finite number of companies and giving yourself the chance to win those deals when they are ready to take money. And that activity in some ways allows you to be lazier. Like the lions laze about all day and then they go hunt, right? But really what it means is it allows you to be more reflective and choosing the right game to win, which is a common thing that entrepreneurs and startups say, choose the right game. And I think for me, when I say don't confuse hunting with gathering, it's that insight. It's that hunting is all about thinking big, having a theory, and then really going out and trying to identify and win the best deals in that space. Gathering is this idea of you're still out there, but you're more passively and often with much greater effort chasing, thinking about, talking to hundreds of companies instead of dozens.
It's interesting because different investors have different approaches. Some define themselves as thesis-driven, which I think aligns with your concept of hunting, versus others who intentionally don't formulate theses and let smart entrepreneurs shine the light on opportunities.
That's right.
I'm sure there are pros and cons of the various approaches, and it'll be interesting to unpack those with investors of different types over time. Sounds like you tend to be thesis-driven.
That's exactly right. I mean, I listened recently to an interview with the founder of 500 Startups, who's very explicitly in the opposite camp, right? That's why it's called 500 Startups. And I think it really can work, and I think it has worked for them. But, we're a fintech specialist fund. And that really puts the pressure on us that our LPs have hired us to find great companies in a subsector, and our brand is the best advice you can get anywhere. And so that requires a level of depth and focus that I'm not sure we could do it if we weren't thematic.
Yeah. What stages are you investing at? It sounds like they're two components of the most recent fund.
Yeah, that's right. So we would talk about the early stage fund as sort of the core of the strategy. That's why it's larger. As a practical matter, we can invest anywhere from PowerPoint stage up to pre-IPO. But the core of our strategy has historically and even today really remains trying to lead Series A fintech deals. Now, you can't find everyone. Sometimes the great companies sort of reveal themselves later. So that's why we have more flexibility. Sometimes an idea or a team is so new that you want to get in on the ground floor, so we can go earlier. But the core of the strategy is to try and lead Series A deals. And then I think in general, we would say the early stage fund is pre-seed to Series B, and the late stage fund is sort of probably focused on that Series C, Series D type of place.
I guess that aligns pretty well with the thesis-driven approach, right? I mean,
Yes.
if you're leading Series A rounds, then it means these are companies that are executing on theses that you're potentially aligned with. They're likely showing some traction to validate some of your thinking and their own, and then you can confidently get behind that. Whereas, to your point, if you're investing in either 500 companies or if you're doing pre-seed deals, I think it could be very difficult, right, to lead with precise theses and expect to be able to find great teams that are executing on them.
Yeah, I think that's right. And look, I won't sugarcoat it. Even at the Series A, there's never nearly enough data to be confident, right? Everybody's got, we talk about getting to, often, people talk about getting to $1 million in revenue before you raise a Series A. And that's great. But, that could be 10 customers. It could be 5. It could be 2. That's not a lot of data to be confident that this company is going to get to $1 billion of revenue. And ultimately, the truly great outcomes in venture are companies that just become iconic. They become dominant in their spaces, often in spaces that we didn't even know existed when they were founded. So even at the Series A, you definitely get that idea of execution. You get this idea of they have found something that works. They've found something that looks repeatable. But we constantly find ourselves reminding ourselves just how uncertain our investments are.
So I think another one of your views is that venture is a strange type of capital to use to fund a business. And from an entrepreneur's standpoint, I mean, you can formulate an impossibility theorem, which says, here are the 10 reasons I shouldn't take venture money.
Yeah.
And I think there are actually many, many very valid reasons why you wouldn't want to if you could avoid it. It's become something of an expectation, even a sort of badge of honor. But talk about that, why venture is a strange way to fund a business. I think I would agree with you in a lot of cases.
Yeah. I think there are two audiences for this sentence, that venture is a very strange way to fund a business. And those audiences are roughly maybe entrepreneurs that you meet in your non-venture world. All of us have been, have the experience of having been to a conference and getting pitched by a person who says, well, I'm really a consultant, or, I've got this idea and I can I come pitch you? And you say, whoa. Like, that's actually not, venture is not for you. Right. And in that case, I try to say venture is a very strange way to fund a business, because you do have to throw out so much of what you should learn as an entrepreneur in order to build a company that is ambitious enough to be unprofitable for 2, 3, 5, 10, 20 years. Because if you think about it from a corporate finance perspective, assuming that you're the kind of business with good unit economics, so you actually do make money on the marginal customer, the only reason you should lose money is that your fixed cost base is so large that it's worth it to lose money in aggregate, even though you're making money at the margin. And that can only be true if the opportunity in front of you and the ambition of the team is large enough to justify that huge fixed cost base. So that's the first audience, is just remind sort of regular people that you might talk to about your life, regular entrepreneurs, you don't want what I'm selling, because it comes with a set of expectations and practices that kind of don't make sense in the business world. And then I think the second audience, which in some ways is the even more important audience for our day jobs, is companies who have been venture backed and maybe shouldn't take another round. And this is a very difficult problem for venture-backed companies that more and more of them have been struggling to realize, learn, or navigate a path through since the end of the great boom in 2021. So this is where I think the conversation gets very difficult, but where it's so much more important, which is, are you sure that venture dollars are the right dollars to fund your business today? And in this context, often you have to hold a mirror up to the founder and say, we're close enough to the public comps, and the public comps don't give you a 10x revenue multiple, right? The public comps might give you, a 10x EBITDA multiple or a 20x EBITDA multiple if you're lucky. And so actually you shouldn't be even trying to take this money. Instead, you should be finding your operating leverage inside your existing cost base. You should be really charting and executing on a path to profitability. Or maybe you need to become a turtle and just survive a market cycle, but survive equals thrive, right? So there's a lot of context in which, even for a venture-backed business, venture capital is a very strange type of dollar to use to fund your business. And I think in particular, we all have to judge with our CEOs, when is the right moment to learn that lesson? For some companies, it might be after the seed. For other companies, it might be long past IPO. And these are the very, very difficult conversations that I think investors and founders need to be having, and they need to be having them very openly, which is why I've sort of been reminding even those of us in the venture capital community that this is a very strange type of capital to use.
Mm-hmm. How would you say that the conversations you tend to have at this point on a day-to-day basis break down between difficult conversations with either existing portfolio companies or venture-backed businesses that are seeking follow-on funding to survive versus businesses that are thriving or earlier stage businesses who have potentially a lot of market opportunity in front of them and that aren't currently crippled by a challenging capital structure?
I think every single one of these conversations is different. They're really all difficult because at some level you are having a conversation about the reality versus the vision. How long is it going to take to get there? How much belief do you have? How much belief do I have? Even if we both believe that we can get there, how long is it going to take? How much provisions do we need to get there? So every conversation is different. I would say that one of the very interesting conversations and tensions is actually with those early stage companies when we are choosing to invest. So you lead a Series A and you say, here's the deal. Prior to 2023, probably no one would have told you to think of the Series A as your last round. And the only reason I'm investing is because I think there might be an absolutely giant opportunity here. But neither you nor I know whether this is a medium-sized opportunity or a giant opportunity, because we can't know that yet. So what I want to do with you is to run a series of experiments and to use this capital, most importantly, to find out whether this opportunity in front of us is huge, or whether it's medium-sized, or whether it's not there at all and we're all mistaken. And then I want together to have enough capital, even in the Series A, so that when we find out which of those answers is true, we still have options. And this is a very challenging thing to do because it's also true that market opportunities only exist in their current shape for a small window of time, right? Stripe couldn't have been Stripe if it started in 2018. So different market opportunities exist, and once they're seized, once a winner emerges, those winners often tend to consolidate. So there's this very interesting and challenging balance that we're having now in this kind of real world, this regular interest rate world, where we are working with founders and trying to create frameworks for them to do experiments and then make decisions. And sometimes those decisions mean aggressively spending the money we've given them. And sometimes those decisions mean, hey, even though we're a lot smaller than we thought we could get, actually we should chart a path towards profitability. And that framework, moving fast enough to seize what might be an ephemeral opportunity from a market structure perspective, but slow enough to not waste dollars if the actual opportunity is smaller than we think. And that, I think, is the most interesting challenge that venture investors are dealing with, even as they invest. The later stage stuff is much more wrenching emotionally, because there's often big teams. Often there are cuts, people with real livelihoods who've dedicated huge amounts of energy. But those conversations, even though they're emotionally wrenching, they're actually much more just rational. You can look at the shape of the business, you can look at the growth, you can look at the KPIs, and you can have very difficult but very fact-based conversations. In the early stage, you're talking about tests, conjectures, predictions, and ultimately experiments, and trying to figure out, how do you chart a path from here to the largest possible outcome?
What's your sense of the state of the venture market at this point in time, February 2024? Are we in for 12 to 18 months of pain, both among startups and VCs? Or are we looking at enough green shoots to see potential turnaround? And interestingly here, maybe we can leverage some of your perspective in the past in a kind of macroeconomic policy world.
In general, I'm a bit of an optimist on the US economy. I've for a long time said we shouldn't bet on a soft landing because soft landings are statistically really, really rare. At the same time, if you look at the current economic performance, the US economy has just continued to perform amazingly well. And especially amazing when you consider that both developed and emerging market peers are performing worse. So the US economy is in some ways an incredible marvel. Paradoxically, from a venture perspective, that means that actually the cost of capital is likely to stay higher for longer, which means that there's going to be the time of challenge is going to remain. Now, I think that that's going to stay, hopefully normalize into what I would call like a stable period of challenge, right? Where having the conversations we just had about it's a very strange type of capital. How do you make good capital allocation decisions? What does it take to run the business? How much are we investing for what types of learning? Those are the kinds of things that are those conversations are easiest when the cost of capital is high but not volatile. And I think we're going to stay in that mode for a while. At the same time, I think a lot of venture investors basically took something like a year off. From, call it mid-2022 to mid-2023, the right answer was no every single time. And at some level, this is a job. And so people have jobs to do, and they will find ways to invest. That nobody takes 2 years off. So I think we're finding that creeping back. We see increasingly that a combination of narrative and traction is getting reasonably high prices pretty fast. It isn't quite 2021 where just a narrative would get you a term sheet in a day, but it is a world where we are increasingly see pretty high priced companies relative to traction receiving term sheets in a week or two. I don't know how long that lasts, but I do think you're seeing that dispersion because of this combination of narrative, traction, and the fact that dry powder conversation eventually, if we are to keep our jobs as venture capitalists, then people feel the need to deploy. And I'm a little nervous about that because I think sometimes I'm seeing rounds that don't make sense to me, or I'm passing because of price, or I'm saying, I think this round would be better to do 6 months from now when you have more data. So that makes me very nervous, but you can easily see why the industry pressure says like, hey, this is my job. I didn't do any deals for over a year. I've got to do at least one deal in the next 6 months. And I think that is a tension that the venture folks are dealing with right now. And it makes me a little nervous, but it's easy to see why it's happening.
I can see why there's a lot of pressure on venture investors. Does that mostly come from their LPs? Does it come from their colleagues? Is it a sense that they need to be generating track record to raise future money against? Is it a desire to avoid having to return funds? Or is it simply the sort of collective sense that we all have about how we need to be working all the time?
I would probably rate it in the reverse order to what you said, right? I think the last thing you said is most true, that they love this business, right? We're in the business because we love founders. We're in the business because we get excited. I would say least important is the LP pressure. Every LP that I talk to says, we want you to deploy this money well. We want you to do great deals. That's the only thing we care about. At the margin, take more time, not less. So I think the LP message is pretty clear and consistent. And I think that in the middle is something like people want to build their careers, they want to build their track records. But I think the most important factor driving it is people are type A. They like the job. They want to do it. They get excited. I think the fear that I would have looking around the market is a motivated reasoning, right? Where the underlying dynamic is a panic about whether we're good at our jobs. And that presses us into motivated reasoning and doing deals that aren't as good as we should rationally hold the bar for. And that's a big message that I think we all at QED repeat to ourselves and repeat to each other about giving each other space to not invest. Hey, it's okay. Wait for your pitch. Do great ones. Be theme-based. Go hunt. Don't just be reactive. Oh, this one seems hot. I think I need to put in a bid.
So you talked about how narrative plus traction is getting deals done over the past, I imagine you're talking about 3 to 6 months. What are the narratives that you see being most relevant to the market right now?
Well, I'll give you, I don't know if these are most relevant to the whole market, but I'll give you 2 that I'm excited about. So these are narratives that I'm finding a little like catnip these days. I think cross-border payments remains really interesting. In particular, I find it interesting because there already are a number of very large startups that are sort of emerging into incumbent status, whether that's a Neum, an Airwallex, an Airbase, right? There's some very powerful companies that have made their bones in cross-border payments. Rapid is another one. And yet, at the same time, it is true that FX for companies of all types is incredibly difficult, incredibly costly, and supply constrained. And one of the narratives, sort of the big macro stories that I think underlies this, which is one of the reasons why I get excited, is the emergence of more of a full network, a full payments network, a full commercial network, as opposed to a hub and spoke commercial network. So if you think about a pre-internet era, it would be very difficult for a company in Mexico to do business with a company in Indonesia. And so I think the dominant commercial relationships tended to go through multinationals. They weren't exclusively US multinationals, but they were multinational companies, multinational distributors. And so if you were a company in a country like Mexico, you would tend to have to do business with a much larger company, and then that much larger company would go do business in some sense on your behalf. Maybe there's some value-added processing. Maybe it was just brokerage and distribution with a company in Indonesia, for example. And I think with the rise of the internet, you see that discovery process has been democratized, right? You have these massive marketplaces like Alibaba, other types of marketplaces that are constantly evolving. And the desire and the ability to do trade on a cross-border basis at much, much lower levels of company size and maturity, and between countries that are viewed as higher risk by the US or the European financial system, creates a lot of pressure for access in cross-border payments. And so what I like about cross-border payments as a for example is it combines both a lived experience of companies that really feel like this is a pain in their day-to-day and a very large macro trend that you have reason to believe could persist. And in particular, it will persist, or at least could persist, especially because of a deglobalizing dynamic. If the pathway between China and the US is more strained, then if you're an Indian company, you definitely want to hedge against your pathway for commerce to go through those two countries. You want to find more spoke to spoke, edge node to edge node commercial opportunities. So that's an example of a big narrative that combines a really lived experience pain point with something that could be plausibly true every year for the next 20. And that's the example that I give of a narrative that really starts to resonate and get a lot of excitement if you can show a fast-growing company that attaches to that narrative. Another one that I'm excited about, and it actually is a little bit linked to the first, is this idea of closed-loop payments. We're fintech investors. People love payments. Payments business models seem to be really great. The biggest successes in fintech have been payments companies. And at the same time, these companies charge a very high amount, 3% of gross, just to complete a transaction. So how can you solve that problem? How can you lower the cost of payments? Certainly, you can automate, you can have better fraud checks. A lot of the cost of payments is the cost of fraud. But also, you can potentially do what are called closed-loop payments, where the actual payment itself is within one single pot of liquidity. So, two examples that I think people might not realize are examples of closed-loop payments. American Express is a closed-loop payment network. When you swipe on the American Express card, you are paying the bank, American Express, and American Express is paying the merchant directly. Both of you have accounts at American Express, so no other financial institution needs to be involved to complete the transaction. Interestingly, stablecoins are also closed-loop payment networks. There is a trapped pot of liquidity, and when you transfer a stablecoin, you're transferring a claim on that trapped pot of liquidity, so no other financial institution needs to be involved. And I think this is a really interesting insight if you believe, as I do, that especially when you move into B2B payments, the pressure on cost is going to be extremely high. And in order to take advantage of those opportunities, in order to disrupt existing payment modalities, you're going to need to find a way that's not just automated, not just better at fraud, but actually structurally has lower cost. And that's another example of a narrative that you're starting to see emerging companies that really focus on, I'm going to close that loop, and I'm going to have structurally lower cost that will allow me to deliver other significant benefits.
Wow, there's a lot to think about there. Those both sound like very compelling concepts, and I can see why you're excited about both of them, especially at this point in time. We kind of referenced your background prior to QED earlier. Maybe you can share a little bit about that and how you got into venture. But thinking about what feels like a pretty, I don't know if unique is the right word, but certainly a period of time in which the global macro environment is very impactful on what's happening across various industries, whether it's shipping, whether it's microchips, whether it's AI, certainly high tech, things like payments and other financial services. Plus the, albeit very early, but potential breakouts of some blockchain network-based use cases, whether it's stable coins like you referenced, or potentially some of the TradFi interest in on-chain capital markets, even potentially sovereign issuer interests in things like CBDCs, potentially token native public debt. There are a lot of interesting tectonic plates that seem to be shifting around at this point in time.
I think that's right. So I was at Treasury for 8 years. I joined at the start of the financial crisis. I was literally joined on the first day of the Obama administration. And unlike all but one of my political appointee colleagues, I stayed until the very last day. I literally resigned on inauguration day of the next administration. So I got to really see this era, which was, there are upheavals now. That was a real time of upheaval, right? People weren't sure whether any of their assumptions about finance would hold the next day. And coming out of that experience, I really felt like I wanted to be in a place where if financial services was changing, I would be participating in that change and even benefit from that change. And there are lots of interesting jobs that are kind of orthogonal to change, right? If you give people advice, you can give people advice on how to optimize their current business. You can give people advice from how to manage change, but the advice giving doesn't change that much. And I was a management consultant before, and I loved that advice giving, but it felt like it was going to be surfing a wave rather than really being powered by the wave. And what I love about venture capital is that if you understand one of these changes in a way that turns out to be correct, the momentum that comes from it is truly exhilarating. And the excitement that comes from watching a company go from, 2 to 10 to 40 people, and then beyond that to maybe 100 or 1,000 people, from 2 customers to 150,000 customers, right? Or 1 million customers. That is just an incredibly exhilarating experience. And relating it back to government, one of the reasons I love Treasury is that if you could get something small changed at Treasury, you could affect the entire country, and in some cases, the entire world, in a single action. And that leverage is exhilarating. And I think venture, while slightly less mechanical, the average venture company doesn't get to change the law. It does have that same kind of exhilaration. If you can get something right, you might impact the whole world. When I look at it, I actually think that government policymaking, particularly government service, in an era where policy is being made, which isn't always true. If you're in government today, the place where real big policy is being made is around climate and about, are we going to have an industrial policy and how are we going to shape that? When I was there, the question was, how should we organize the financial system? Now, of course, there's financial regulatory policy happening today, but it's smaller and more incremental than what I had the opportunity. So if you get the opportunity to work in government at a time when true policy is being made, it actually has a ton of similarity to venture. Changing the law, you cannot know in advance what's going to happen, right? History does not afford us counterfactuals, and venture doesn't afford us counterfactuals. And so in that way, the decision-making, the thinking about both is actually really similar. In some ways, the common discourse around government and policy is less forgiving than the discourse around venture. Of course, there are going to be mistakes. Lots of companies fail. At some level, the importance of government, the importance of policy, certainly raises the stakes on us trying not to make mistakes, but also means that we could benefit from some of the culture of venture, which is like, we as a populace, a citizenry, know this is hard. And we're electing you or supporting you or voting for you to try and make the best decisions you can on our behalf. But if you see something that's not working, we want you to try and change it. And we understand that it's very hard to get policy right the first time. And I think that's a culture that is really difficult and we've lost a lot of in the United States. And we have it in venture, which is great. But I think in this era, we're all a little more sensitive to mistakes. So you can see how challenging and potentially damaging it can be when you lose that policy of mistakes are okay. That's what making change means. So I think those are some of the similarities that I think are so important, and some of the learnings you can take from one to the other.
Love it. Well, listen, Amias, I want to be conscious of your time. I don't think we even made it through half of some of the topics that we had sketched out as potential discussion points. Maybe we'll have to reconnect for a round 2 at some point. That would be a lot of fun. Amias Gerety, thank you very much for joining us today.
Always my pleasure. Thank you.
Thanks for tuning in to Rebank. If you liked today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.